and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I'm going to continue the talk regarding GME and what has happened to Keith Gill, also known as DFV in the Wall Street bet community, since he has been asked to testify in the Congress regarding the situation. But what I would like to focus on is what I think he is actually truly doing when he discovered the GameStop stock and what made his decision to actually invest in it, and what I think you could actually have learned from Peter Lynch's book One Up on Wall Street to try and find a stock like GME, and why I think he has actually done a tremendously good job when he initially bought it. Next, I'm going to give an update to my portfolio, what has happened within this week, and I'm going to discuss the latest purchase which I have done. And finally, I'm going to answer a question from a viewer who asked if I think that the stock market is currently overvalued. So if we start by looking at GME, over the last week we have seen a drop in the stock price of more than 80%, from 316 and down to 63.67, and just on Friday alone it has actually been down to 51.5. So a huge drop in the stock price. So the question that a lot of people are asking themselves currently is the short squeeze over, and have we seen the high of this stock yet? So if we then go and check the situation regarding this short squeeze and how many shares are still shorted, we can see that it is still close to 90% of the shares, at least according to this data source, and that it would take close to 3 days to close that position. If we then take the second data source, then it says that it would take 2.5 days. But what we can see with this stock price, they have really done a tremendous job of driving down the stock price, so their losses would not be as big as what we have seen. But if we remember back to the Volkswagen case from 2008, there we also saw, before the huge spike, that the stock price almost dropped back to its original level before we saw the squeeze actually happening. So if that is the case, then we have not seen anything yet. But I can simply not tell you whether or not we are going to see that. Currently, I just think it's really interesting to sit here and follow along on the sideline. If we then go and check the news, then we can see here that Maxine Waters says that she wants the Redditor Keith Gill, also known as DFV, and the CEO of Robinhood, and even some of the top management people from GameStop, to be present at the congressional hearing on the 18th of February. And I mean, I cannot recall a single time in history where we have seen a retail investor having to come and give his statement regarding manipulation of a stock at the Congress. I mean, this is truly history in the making. I will of course leave links in the description below to all the news articles relating to this hearing, which I have been capable of finding within this week. Now, if we go back to this GME stock and then take a look at the graph here for 1 year, what I think that Keith Gill has done and why he has done so tremendously good is, if you look at One Up on Wall Street by Peter Lynch, one of the things that he says, a lot of his 10 baggers, meaning a stock that will increase its value 10 times or more, is it has to be a company which is currently not loved by the current public. So when Keith Gill invested in this back in 2019 and 2020, I mean, he clearly looked at a stock saying, nobody currently likes this stock, but I think that it can actually turn around. And hence he could buy it for a ridiculously cheap price compared to where the stock has actually been trading. So he actually did a valuation play and said, well, currently this stock, which is trading physical computer games out of physical stores, nobody likes that. That is going to be a terrible business. But what the public haven't realized yet is that they are trying to transform their business, and hence they can perhaps become really profitable once in the future. So Not necessarily looking to how many hedge funds were shorting this stock, but simply just at evaluating the business model. It was a good idea to invest in the stock when it was trading back at $4. Of course, this is very easy to sit and say now when you have the hindsight. Now, let's continue with a portfolio update. So the first thing we notice for this week's episode is that there's a green circle, meaning that the portfolio is up in value compared to last week. If we then go to the portfolio values tab here, then you can see that the gap here is starting to narrow between the cost and the value of the portfolio. And you can also see here that the value of the portfolio has increased $8,600 within this week. But as you can see here, the cost has also increased, so you need to subtract the additional costs. And since I have bought stocks for around $4,700 within this week, that means that the portfolio is up roughly $3,800 within this week. So needless to say, this has been a truly astonishing week for me when you see this value increase in the portfolio. But if we then go to my favorite tab, namely the dividends tab, then you can see that the first week of February has truly been amazing to me as well, since I have received more than $178 within this week. And just to highlight the companies which has paid out the dividend within this first week of February, it was a little more than $11 from LTC, a bit more than $25 from Verizon Communications, close to $20 from JP Morgan, a little more than $38 from AT&T, close to $30 from CVS Health Corp, and then finally the biggest contributor, namely Bristol Myers, with a little more than $54, giving me a total of a little more than $178 this week. And just to get even more motivated by the numbers here, if I look at my 2020 Q1 result, I got $340, and so far in 2021 I have already received $318. And if you look at February here and then compare it with November, since that is 3 months back in time, I am definitely on track to beat my previous record of $302 received in a single month, since I have added Bristol Myers on top of what I received here. So I wouldn't be surprised to see if I actually reach more than $350 within February, which I'm really happy about. And while we're on the dividends tab, I actually got a comment from one of the viewers saying it's not really too appealing to youngsters if they want to invest and only get an average yield of 2.8%. Couldn't you have done a better job and received a higher yield than what you currently have in your portfolio, since you're so much focused on the dividends? And sure enough, let's try and play with the numbers here. You can see here that I'm dividing my yearly income with the overview in E36. And what is in E36? That is the cost that I have paid for all the stocks in my portfolio. Let's see what happens to this number if I actually remove all the stocks which are not paying any dividends. So if we scroll up like this, then we can see that I don't get any dividends from Beatrice, I don't get any dividends from Macy's, I don't get any dividends from Ford and from Carnival Corporations. So if I remove the cost of these 4 companies, let's see how much that actually affects the dividend. So if we make that little exercise, and then let me just zoom in so it's even more clear here, then you can see that the average dividend yield in the portfolio will go from 281 to 318 if I haven't bought the stocks which are currently not paying a dividend, or if I have simply sold out of those stocks. And just to continue playing around with these numbers, if I, for instance, were living in the States and didn't pay the 15% in withholding tax, how would the numbers for the portfolio actually look? Well, then I take the number that I have over here in S18, and instead of multiplying it by 0.85, then I just have this number where I just take the sum of all the yearly income that I will get from the stocks in the portfolio. And then you can see here, if I then reiterate here and take T18 instead, that the dividend yield for the portfolio would actually go all the way up to 3.74%, which is much better than 2.81. But unfortunately, I bought some companies at the wrong time, then they slash the dividend. And since I'm not living in the States, I have to pay at least the 15% withholding tax. I know that I will have to pay at least 12% on top of that since I'm living in Denmark. But this is just to compare the numbers so you can see how much you would actually be affected depending on where you are living. And also just to illustrate why, if you for instance are viewing other financial YouTubers and seeing that their average yield on the portfolio is much better than mine, well, since I'm not living in the States, I will have to pay that 15% withholding tax, and I have not even included all the tax that I pay in Denmark, since the minimum that I would have to pay is 27% in total, meaning an additional 12% than what I have actually shown here. If we then go back to the overview tab here, then we can see that the industrial piece of the pie has increased, since that is where I have added an additional holding in my portfolio. So if we scroll up here, and then let me just zoom a bit here, then we can see that the company which I have added is Lockheed Martin, or LMT in the ticker code, and I have added 14 shares, which I have paid $4,766 for. And if we scroll to the right here, we can see that they pay quite a nice dividend, and the dividend yield is 3.05% currently. So how does Lockheed Martin actually fit with the guidelines, and what do they actually do? So if we start by going to Seeking Alpha, then we can see here that Lockheed Martin is down close to 23% within 1 year. But we can see here that they have quite a low PE ratio, 12.79, so that is quite good. If we then go to the dividends tab here, then we can see that the payout ratio is definitely below the 75%, since it is less than 40%. We see that the dividend yield is just above 3%, so also a plus there. We can see that they have a good dividend history, since they have 18 consecutive years of raising the dividend, and over the last 5 years they have raised it close to 10% every single year. If we then look at the dividend yield, then we can also see here in a second that it is probably not the worst time to buy them, since their historical 4-year average has been 2.36%, and currently I'm buying in and getting a little more than 3%. If we then take a look at the peers tab, just to compare them with its competitors, Raytheon, Boeing, Northrop, and General Dynamics. Then if we then scroll down here to the PE ratio, you can see here 12.79. That puts it way in line with its peers, since it is not higher or significantly higher than any of their competitors. You can of course argue that NOC is a little cheaper just based on the PE ratio. If we then look to the guideline diversity across sectors, then you can see here that it definitely fits that criteria, since industrial now makes up more than 15%. Last week it was 12.7%, and now it's 16.6%. So clearly it has increased since I added this company, but not to a too significant level in this portfolio. And finally, we arrive at guideline number 7, strong company potential and a good moat. So let's take a closer look at what Lockheed Martin actually does and see if we can convince ourselves that there actually is a strong company potential and a good moat. If we then go to their web page, then this is what we see on the front: the right weapon system for the next 50 years of multi-domain operations. So just based on that line alone, that shows that they intend to be in business and that they have the right product for at least the next 50 years. That is what they are trying to tell. So let's take a closer look at some of the numbers behind Lockheed Martin and see how it actually looks. If we then go to macro trends and then look up Lockheed Martin, we go to financials and the income statement. Then we start by looking at the revenue, and we can see here that the revenue has been steadily increasing since 2015, and even in 2020 they managed to increase the revenue by 5 billion, even despite the fact of this pandemic. If we then scroll down here, we can then see that the shares outstanding has also been dropping since 2011, meaning that they have been buying back shares, and that would increase the value of every single share that you have. So I also like to see that. If you then compare it with the earnings per share, since there are now less shares in the market, it's not too surprising that the earnings per share is going up, especially not when you have seen that the revenue is increasing as well. If we then continue to the balance sheet, then one thing that I also really like to see is that the value of the assets is higher than the number of the liabilities, so that at least still indicates that this is a solid business also from a financial standpoint. Of course, you could argue and say, well, they have a heck of a lot of goodwill, so if you subtract the goodwill from the total assets, then they would actually have less assets than they have liabilities. So perhaps not as strong as it looks at the first glance, but still well enough for me to actually want to own the stock. If we then continue with key financial ratios, then this current ratio, as I talked about before, that assets is above the liabilities. So what you want to see here is at least a number above 1, which we're currently seeing, since the number is above 1.35. And long-term debt to capital, you want to have a number which is way below 1, since the long-term liabilities should be lower than the capital. Then, for instance, the gross margin is also quite interesting to look at, because you want to have a business where they don't have to lower their margins in order to keep staying competitive. If a company has declining margins, that means that they are earning less and less and less, and perhaps one of their competitors would be a better investment, since they are better at earning money on every unit that they are selling. So what we are seeing here is that we have a drop in the gross margin compared to last year, but it's still up where I think it's in a good range, since it's still double digits. And just to look a little closer at the profit margins, so if we go to margins and then profit margins, then we can see the gross margin here all the way from 2005 up until now. And we can see that if you look at this line, it's not like it has been declining for the last 15 years. So this company is definitely capable of making money for every unit that it is selling. So this is really a positive thing when I take the history into perspective. And just to show you that you can also find a lot of these numbers if you just go to the web page. So if we go back to the web page, go to investors, then go to the financial earnings. If we then go and take a closer look at the Q4 result, then we can see here, if we scroll down, that they have 4 different kinds of business legs. So there's aeronautics, there's missile and fire control, rotary and mission systems, and space. And here we can see that they average to have a total consolidated operating margin of 13.4% compared with 13.5% from last year. So now that we have established that Lockheed Martin works in a very specialized industry, then I would argue that we have actually seen that there is quite a good moat here. Of course, there are those 4 or 5 competitors who is also in the same industry, but it's not like you will see 10 new competitors try to enter this market, since it is simply too specialized, and it will take a lot of research and development to try and compete with these companies. On the downside, of course, that also means that Lockheed Martin is forced to spend a lot on research and development in order to stay on the forefront with the newest systems that the customers actually want to buy. Because if they don't, then all of a sudden they will not have the best technology available, and then the customers will simply go to the competitors and buy that product instead. If we then turn to just a single dividend news update within the portfolio, then I have received this email that Prudential Financial has declared a dividend of $1.15, meaning that they have increased the dividend by 4.5%, and I'm truly happy to receive a newsletter like this, since I have 62 shares of Prudential Financials. If we then go to questions from the audience, then I have received a question that goes like this. Hey LMG, aren't you concerned about that the market is currently trading at all-time high levels And shouldn't you be keeping more cash just in case of a market crash coming? Well, first of all, that is an excellent question. And let me try and reply as best as I possibly can. So, if we go to the Shiller PE ratio, then I agree when we see here that the PE ratio for the market is above 35. The only time we have seen that previously was back in 1999. And if you have been an investor for more than 20 years, then you for sure remember what happened after 1999 in 2000 and the dot-com bubble, where we saw the market dropped severely. So I'm not saying whether or not we are going to see a market crash. Let me just try and highlight what I think are some of the differences this time. So for instance, if we take a look at the 10-year treasury note, look at the interest rate now. Currently it is about 1.19%. And I mean, back in 1999, it was more around 5%. So currently you don't have a lot of options as an investor to see a good return on your money unless you're willing to take more risk. So from this standpoint, then you would argue and say, well, then stocks are actually still quite cheap, because compared to the risk-free rate of the 10-year treasury, then stocks are actually not that expensive compared to what they have actually been. Because if you say that they should have a proportion to the interest rate, well, then stocks could easily trade 4 times higher currently than what they are doing. But at the same time, if we are to see increase in interest rates, I'm not saying that we're going to see that within the next half year or within the next year. I have no clue to when you would actually expect an interest rate increase. But what you have seen and what you have heard in the news is that they're not even thinking about increasing the interest rates currently. And my next point would be, remember, it is not a stocks market, it is a market of stocks. And what do I mean by that? Well, there will always be businesses that are trading at a fair price which you are willing to pay. I know that when the stock market is trading at all-time high levels, then you will have a much more difficult task to actually locate them and find them. And at the same time, I of course understand that you are worried that the market will drop severely since we are trading at these all-time high levels. That is why I'm trying to invest in businesses I think are capable of withstanding such a decline from the market. So in this case, defensive stocks. I'm not talking about the weapon industries, which I have just invested in, but more companies like they are producing something which you will always need no matter what is happening. So for instance, the demand for toilet paper or the demand for toothpaste will not go down just because you see a decline in the stock market. But for instance, people are probably not willing to go on cruise ships if they don't have any cash at their hand, as you can see from my portfolio. So I truly get why you are concerned that the market is trading at these all-time high levels, but at the same time, I wouldn't suggest that you stay completely at cash, because sure, we will see a market drop, but if it happens half a year from now or if it happens 8 years from now, I cannot tell you. But I can truly tell you, if it happens 8 years from now, then you will be sorry that you didn't invest anything. So something between 0 and 100%, I mean, that doesn't say anything about how much you have to invest. You always have to go with your gut feeling, but I would say staying completely at cash and knowing with certainty that your money is losing value due to either a low interest rate or even a negative interest rate and an inflation of around 2%, then I prefer taking some risk and say, well, I don't need the money for at least 5 years. That is why I am comfortable adding the money into the stock market and taking that risk, because I'm not trying to predict what the market is doing 1 year or 2 years from now. I will say 5 or 10 years from now, it will be higher than what it is today. So that sums it up for yet another exciting week of the Lazy Money Game. So now you know the latest news regarding Keith Gill, also known as DFV, who will have to testify on the 18th of February in the Congress regarding the GME stock. You have seen the latest update to my portfolio and my reasons for why I have decided to buy Lockheed Martin. And finally, this question from the viewer on whether or not I think that the stock market is currently overvalued and how I want to continue even with the knowledge that I have. So if you like content like this and you have made it all the way to the end, then don't forget to hit the like button, remember to leave a comment or subscribe to the channel, it really helps me out. And until I see you next Sunday, bye!